successful stock investing. It feels like it should be simple, doesn't it? Buy low, sell high. Yet, so many people find it a real challenge to consistently build wealth.
Yeah, you just have to think back to the late 90s, right? The dot-com boom.
Oh, yeah.
It felt like you couldn't lose money.
Right. Impossible.
And then, bam, the bubble burst. A pretty stark reminder that the market definitely has its own rhythm. It's not always predictable.
Absolutely. And those stories of quick fortunes, they're exciting, but real success, long-term success anyway, seems to come from a much more, let's say, deliberate path, more educated.
That's it, exactly.
Yeah.
And that's what we're really digging into today.
We've got a great guide for this. The 5 Rules for Successful Stock Investing by Pat Dorsey. He was Director of Stock Analysis at Morningstar.
A really solid source.
Yeah. Our mission here is basically to cut through the noise, pull out Dorsey's key ideas, and give you, the learner, a shortcut to his fundamental approach, help you avoid the common pitfalls.
And Dorsey's approach, it's really built for the long haul. It's meant to give you a solid framework, whether you're, just starting out or you've been investing for years. It's all about building that foundation for making smarter choices.
Exactly. And he gives us 5 clear rules to follow. We're going to explore each one.
Okay.
They are: 1, do your homework. 2, find economic moats. 3, have a margin of safety. 4, hold for the long haul. And 5, know when to sell.
Sounds like a plan.
So, yeah, let's jump in and figure out how to build wealth thoughtfully, effectively.
This should be really practical. I think these rules offer really concrete steps for anyone serious about investing.
Okay, let's dive into rule number 1. Do your homework. Now, that sounds, almost too obvious, right?
Yeah. Of course you do your homework.
Look both ways before crossing the street, that kind of thing. But Dorsey really argues this basic step is not only crucial, but maybe often overlooked.
Yeah, and what he means by homework isn't just, knowing the company's name. It's much deeper. It's things like developing a real understanding of accounting. So you can actually read the financial statements and figure out what kind of shape the company's in.
Okay.
And also thoroughly researching the business itself. Like, what do they sell? Who buys it? What are their big challenges, opportunities, the whole picture?
Right. So it's about being able to decide for yourself if it's a good investment.
Exactly. Not just taking someone else's word for it, no matter how convincing they sound. That independent thinking based on your own research, it's just so vital.
And that research obviously takes time, effort.
It does. But Dorsey actually sees that time investment as a good thing, like a cooling off period.
Ah, interesting.
Yeah, it helps you avoid jumping in impulsively just because there's a lot of hype around a stock.
Yeah.
Or you feel like you're missing out.
That makes sense. And this deeper research really pays off when you think about long-term investing versus, say, frequent trading, doesn't it?
Oh, absolutely.
Yeah.
Dorsey shows data, I think it's figures 1.1, 1.2, 1.3 in the book, that clearly illustrates how investors who hold for the long term generally do much better than frequent traders.
And that's even after factoring in things like taxes and fees.
Yeah, exactly.
Yeah.
Especially taxes on short-term gains. And all those brokerage fees, even the small ones, they really add up. They just chip away at your returns.
Right. So those seemingly small costs, they can take a big bite over time. Rule 1 isn't just about being diligent. It's setting yourself up for potentially better long-term results.
Precisely. And understanding the company deeply gives you the conviction to stick with it when the market gets bumpy, which, let's face it, it always does.
Okay, great foundation. Let's move to rule number 2. Find economic moats. Now, economic moat, that sounds a bit more technical. What's that about?
Yeah, it's a key concept for Dorsey. Think of an old castle.
Okay.
It had a moat, right? That big ditch filled with water.
To keep attackers out.
Exactly. So in business, an economic moat is basically a company's sustainable competitive advantage. It's what protects it from competitors and lets it earn high profits over, the long run.
That's a really helpful analogy. So the idea is that without a moat, competition just erodes profits over time.
That's generally how it works in a free market, yeah. If one company's making huge profits, others will jump in, offer similar stuff, prices come down, margins get squeezed.
Right.
So Dorsey says you need to find companies that have these strong, lasting moats to fend off that pressure.
Okay, so how does a company actually build this metaphorical moat? Dorsey outlines 5 main ways, right?
Yeah, 5 key sources of moats.
Let's walk through them. First is creating real product differentiation through superior technology or features. What's a good example there?
Well, Dorsey uses Tiffany's, their brand, the quality perception. It lets them charge premium prices. That little blue box means something, right? He contrasts that with, say, Sony or Ford. Big brands, sure, but they haven't always translated that into consistently superior returns for investors.
Interesting.
But then you have brands like Abercrombie and Fitch, Coke, Disney. They've shown more staying power in terms of pricing.
Okay, so it's about brand power that actually translates to profit. What's the second way? Creating perceived product differentiation through a trusted brand or reputation. How's that different from the first one?
It's subtle.
Yeah.
Real differentiation is like objectively better tech. Perceived differentiation is more about the customer's feeling, their trust in the brand, even if the product itself isn't vastly superior. Think about like why someone always buys one brand of coffee.
Ah, okay. It's the feeling, the trust.
Yeah, the perception of quality or reliability.
Got it. Third moat. Driving costs down and offering a similar product or service at a lower price. That seems pretty straightforward. Be the low-cost leader.
Exactly. Think Southwest Airlines or Dell back in its heyday with the direct model. Dorsey also mentions Vanguard in finance. Their mutual ownership structure lets them keep fees super low. That's a huge cost advantage.
Makes sense. Okay, number 4. Locking in customers by creating high switching costs. That sounds powerful. How do companies do that?
Basically, they make it really painful or expensive for customers to leave. Dorsey uses medical device companies like Stryker or Zimmer. Surgeons train extensively on their specific equipment.
Ah, so switching means retraining, disruption.
Exactly. Big hassle. Dorsey says you should ask, how much training is needed? How integrated is the product? Are there industry standards locking people in? Is there pressure from clients not to switch? Does the benefit of switching really outweigh the cost and pain?
Those are great questions. Okay, 5th and final way. Locking out competitors by creating high barriers to entry or high barriers to success. Examples.
Well, there's regulatory stuff like casino licenses. Only so many are given out.
Right, built-in limit.
Or patents, especially in pharma, like Pfizer. They get exclusive rights for a while. And then there are network effects. Incredibly powerful. Think Microsoft with Windows or eBay or even Western Union historically. The more people use it, the more valuable it is for everyone, which makes it super hard for newcomers.
Okay, those are the 5 sources. But then Dorsey asks a crucial question. How long will it last? Not all moats are created equal in terms of durability, are they?
No, definitely not. That's a key point. Tech advantages, for instance, can disappear really quickly as something newer and better comes along.
Right.
Dorsey argues that moats based on, say, low costs, strong brands, customer lock-in, or regulations tend to last much longer. They're more durable.
And he gives examples in the book, right? Figures 3.2 and 3.3, companies with narrow moats versus no moats.
Exactly. Like he puts Federal Express, Nokia, Kraft in the narrow category.
Okay.
And companies like GM, Micron, Circuit City as having no real moat. It just shows that being a big, well-known company doesn't automatically mean you have a sustainable edge.
Yeah, that's a really important distinction.
And from there, Dorsey says the next step is industry analysis. You got to understand the whole competitive environment the company operates in to really judge that moat.
Okay, makes sense. So we've done our homework. We've looked for those protective moats. Now, rule number 3, have a margin of safety. This feels critical, especially with market swings. What exactly is this margin of safety?
It's fundamentally the gap between what you think a stock is really worth its intrinsic value and the price you actually pay for it.
Okay.
And Dorsey stresses this because, well, valuing a stock precisely is really, really hard. It's not an exact science. So the margin of safety is your buffer.
So it's like building in some wiggle room.
Yeah.
Acknowledging your analysis might be a bit off.
Precisely. It's insurance. Insurance against paying too much and also insurance against just being plain wrong in your analysis of the company's future. This idea comes heavily from Benjamin Graham, the father of value investing, Warren Buffett's mentor.
Right. And how does Morningstar, where Dorsey worked, put this into practice?
Well, they use a discount rate when they value companies. Basically, they estimate future cash flows and then discount them back to what they're worth today. That discount rate reflects the company's specific risks.
Okay.
And that whole process of discounting inherently builds in some conservatism, some margin of safety. Because future money is worth less than money today, right?
Right, due to risk and inflation and opportunity costs.
Yeah.
And Dorsey mentions Morningstar uses a range for this margin. It varies.
Yeah, he says for, really stable companies with wide, strong moats.
Yeah.
The super reliable ones, maybe a 20% margin of safety is enough.
Okay.
But for riskier companies, maybe ones with no moat at all, you'd want a much bigger cushion, maybe 60% or even more.
That makes total sense. More uncertainty, bigger safety net. So ultimately, it's about protecting your capital, avoiding those permanent losses by just admitting we can't predict the future perfectly.
Exactly. It stacks the odds a bit more in your favor and cushions you against nasty surprises.
Okay, halfway through. Rule number 4, hold for the long haul. This feels especially important now with, 24/7 news and the temptation to react to everything.
Oh, yeah. Dorsey is a huge believer in the long-term perspective. He actually points back to that figure 1.1 again, just to hammer home the power of compounding over time and how jumping in and out of the market really hurts your returns because of taxes and trading costs piling up.
It's that snowball rolling downhill, isn't it? The longer it rolls, the bigger it gets, and less gets chipped away by costs.
That's the idea. And Dorsey specifically warns against trying to time the market. Such a common temptation.
Huge temptation.
Yeah. He even references a study, I think it was in the Financial Analyst Journal back in 2001,
Okay.
that basically showed buy and hold strategies tend to beat market timing pretty consistently. Because, one, predicting short-term moves is incredibly hard, maybe impossible to do consistently. And two, the benefits of timing, even if you get it right occasionally, are often overstated anyway.
Right. And Dorsey also lists some common mistakes that kind of derail this long-term approach, doesn't he? Things to watch out for.
He does. He warns against swinging for the fences, basically taking huge risks on speculative stocks, hoping for a quick home run. Another one is believing it's different this time. Ignoring history, especially when markets get frothy.
It happens every cycle, feels like.
Then there's trying to time the market, which we just talked about.
Yeah.
Also critically ignoring valuation, just falling in love with the story and paying way too much kills your potential return. And finally, relying on earnings for the whole story, just looking at, say, earnings per share and ignoring everything else about the company's health or moat.
Those are all such good reminders to, stay disciplined, avoid the emotional roller coaster.
Absolutely. That long-term view combined with the first three rules, the homework, the moat, the margin of safety, that's really the core of building wealth steadily over time.
Okay, final rule, number 5. Know when to sell. Now, this feels a bit like a twist after just talking about holding for the long haul.
It might seem that way, yeah. But while ideally you'd hold great companies forever, Dorsey is realistic. Sometimes you do need to sell.
Okay.
But crucially, he says the reason isn't because the stock price went up or down recently. Past performance isn't the driver. It's about the future.
Got it. So what are the valid reasons, the triggers, to think about selling?
He gives a few key ones. First, if the stock has dropped a lot, it might mean your original idea, your thesis, was just wrong.
Ouch.
Yeah, maybe you misjudged management or the competition or some big industry shift. Dorsey basically says sometimes you just have to admit the mistake, cut your losses, and move on. Don't hang on hoping for a miracle.
That takes discipline. Okay, what's another reason?
Second reason, the stock price has gone way up, far beyond what you think the company is actually worth, its intrinsic value.
So even if it's still a good company?
Yeah. Sometimes the market just gets too excited, too optimistic, and pushes the price to irrational levels. If the market is offering you a price that's way, way higher than your valuation, it might be smart to take those profits off the table.
Okay, sell into strength when it becomes extreme strength. What's the third main reason?
The third one is if the company's actual fundamentals start to deteriorate significantly.
Like what?
Things like growth slowing down dramatically, profits declining, debt piling up, or really importantly, if its economic moat starts to erode. If those competitive advantages that made you buy it in the first place are weakening, that's a big red flag. That's a strong signal to reconsider holding it.
So it's definitely not buy and forget. You have to keep checking in on your investments, make sure the story still holds up.
Absolutely. Continuous monitoring, being willing to reevaluate your initial reasons for buying, that's essential for long-term success.
Well, there we have it. Pat Dorsey's 5 rules for successful stock investing. It really does provide a clear, sensible framework, doesn't it? Based on that solid Morningstar philosophy.
They really do. These rules, they seem simple maybe, but they offer a really powerful and I think timeless foundation for investing. It's all about that research, understanding competitive advantages, being disciplined about price, thinking long-term, And, yeah, knowing when the story changes.
And as we wrap up this deep dive, here's something for you, the learner, to think about. Which one of these 5 rules do you think might be the toughest for you to stick to consistently?
That's a good question.
Is it carving out the time for that deep homework? Or maybe resisting the urge to trade too often when the market gets volatile?
Right.
Or perhaps having the guts to actually sell a winner when it gets way overvalued? Or even sell a loser and admit a mistake?
Yeah, identifying your personal hurdle.
Exactly. Think about what systems or habits you might need to put in place to overcome whatever your biggest challenge might be. Because ultimately, successful investing isn't just knowing the rules, it's actually putting them into practice day in, day out.